To wrap up this session, we'll discuss the casualty and theft losses. To begin with, non-business casualty and theft loss deductions usually result from a lost or damaged item due to some unexpected circumstance, such as storm-caused damage. Some areas of the country are much more prone to weather-related damage than others.
However, regardless of where they live, taxpayers only claim losses caused by federally declared disasters, according to the Tax Cuts and Jobs Act.
To determine the deductible amount of the loss, first you need to determine the adjusted basis prior to the damage. Subtract the fair market value of the item after the damage from the adjusted basis of the item before the damage. The difference is the amount that might possibly be deducted. For instance, if a tree fell and damaged your client's car, there may be a loss. If the adjusted basis of the car was $10,000 prior to the damage, and the fair market value after the tree fell was $8,500, then there's a potential damage amount of $1,500. Of course, if you do have insurance, which reimburses a certain amount, that has to be deducted from the damage amount. After doing all this, you then deduct $500 and subtract 10% of the taxpayer's adjusted gross income. Whatever is left, if anything, goes on the line for casualty losses on Schedule A. Form 4684 will lead you through this process and should be attached to the return if you have a casualty and theft loss deduction. Due to these limitations, you'll find that casualty and theft losses are few and far between. The first 5 deductions that we have covered to this point are by far the most common deductions on Schedule A. The remaining Schedule A deductions occur infrequently. We'll discuss those in the next session as we wrap up itemized deductions.